What's up, guys? Today we're going to talk about the problems of using metrics in per share values. Let's go. Per share values are everywhere: earnings per share, dividends per share, free cash flow per share. So, what's the problem? The problem is share buybacks, and particularly the excessive amount of share buybacks. Most companies buy shares above intrinsic value, so they are undisciplined when they are doing it. Um, An exception to this is Berkshire Hathaway, for example, and this increases many of the ratios that investors use, such as earnings per share, dividends per share. A company that profits the same amount every year but buys back 5% of its shares with it will increase EPS and DPS at a 5% CAGR, and that's compound annual growth rate. Is this creating value invariably? It might if they are buying below intrinsic value, but the problem is that most often they don't do so. Let's use an example of per share math. And to do this, we'll take a look at Nike. And if you'd like to follow the images, the graphs, you can visit the website on stockpickinginsights.com. On these graphs, you will see historic data, and that historic data contains 3-year average net income over the last 14 years, 3-year repurchase of common stock, so stock buybacks, and the EV multiple softened because the denominator is 3-year average net income. What you will find is that these three measures all went up since 2006 up until 2020, with the exception of net income that went a bit flat in the last 3 years. We can see the results of that behavior by looking at the next graph, which contains shares outstanding and 5-year CAGR of those share buybacks or repurchases. And we'll see that 5-year CAGRs since 2011, so that contains 5 years back before 2011, so 2006 up until 2011. And those 5-year CAGRs are around 1.5 to 2%, and that means that they bought back 1.5 to 2% of their shares every year if you consider on the performance over a period of 5 years. Even if you consider that they are repurchasing shares at intrinsic value, does that repurchasing mean that Nike will sell more shoes in the future, or earn more from selling these shoes, or keep selling them for longer? And by that I mean maintaining competitive advantage. You understand what I'm trying to say, and the answer is no. The net income is the same regardless of how many shares there are. With these considerations, this repurchase plan is simply a dividend, but you already knew that because we are considering that they are repurchasing at intrinsic value. The real distortion comes when you mistake this behavior for growth. You don't say that a company grows at a 2% CAGR when they distribute a 2% dividend, but the market interprets these buybacks as undervaluation. The history goes like this: a company buys back stock, market interprets as undervaluation and pushes EV multiples up. Company keeps buying back stock at unsustainable EV multiples. The market realizes that they would have to grow too fast to sustain this valuation, this EV multiple. EV multiple comes back down, and that's the end of the story. Along this way, they bought less shares than they should because they overpaid, they paid too much. My point is, it gives you a better picture and at least more margin of safety to look at the whole value. And by that I mean using net income instead of earnings per share, for example. There can be exceptions to this, as I was saying at the beginning, and Berkshire Hathaway is clearly one of them. If you consider Warren Buffett to be a good capital allocator, which many people do, you trust him to be buying back shares at or below intrinsic value. That means that per share growth due to buybacks is still distribution, but at least it isn't destroying value. Using per share values in Berkshire, quantitative analysis is not that big of a problem compared to Nike, for example. Still, if you owned 100% of the business, and by that I mean paying enterprise value for every share outstanding, per share values wouldn't even matter as you own every one of them. Also, buying back shares wouldn't even be a capital allocation option. And if the company was private, I mean. That is why I sweat when a company excessively buys back shares, and I would rather like to see them investing in their operations and so reinvesting the profits, or if they really have to distribute it, be careful with buying back shares at or below intrinsic value, or if they can't do that with a dividend. And that's it. That's my take on why you should use whole values instead of per share values. If you like this content, please subscribe, and you can do that in the stockpickinginsights.com website. And we'll see you next week.